Welcome to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main, president of Main Financial Group, as well as joined by Adam Freund, CRC of Main Financial Group. And to our viewers at home in the Detroit area, thank you as always for spending time with us. Today's show, we're going to talk about clarity and chaos. And what do we mean by that? We're going to talk about market volatility. And so think about this for just a moment. Market volatility is obviously something that every investor experiences, but when you're in your retirement years, why does it feel so much more personal? Why does it feel to impact you even more so in those years? And we're going to talk about what volatility really means for your retirement, and most importantly, how can you have clarity and peace in the storm? So thank you for being with us today. Jordan, how are you?
I'm exceptional, and what a great topic today.
Yes.
I mean, something that people don't always want to talk about, but it's the elephant in the room. So we're excited to get into this. How are you today?
Fantastic. Thank you so much. Adam's looking for the elephant. How are you, my friend?
I am fine. Jordan told me to say that.
I was going to say, that's not your usual vigor that you bring. We want some more.
He told me to say that.
We toned him down a little.
I know. It's like, we're going to tune you back up. Okay. So market volatility, let's talk a little bit about that. Volatility and risk, if you will. When we talk about market volatility, what does that actually mean for someone that's nearing or in retirement? That could be you in the viewing audience. What does it mean to you? What does it mean to that viewer?
I think it's the emotion of a loss impacts you more than the high of a gain, right?
That's true.
Emotionally. And because you're in retirement, you don't have a lot of time or as much time to recover, as well as more money isn't coming into your portfolio, right?
Yes.
So these volatile swings really affect people emotionally. If you look at it, even in a up year, let's say, the market will be down at different points throughout that year.
It's true.
It's not just a straight linear upshot. I mean, if you just look at the first quarter of 2026, you know, the media had said, oh, it's the huge market, you know, chaos and wars and other things. But for the first quarter, the various indexes were down 3 to 5%. Yeah. And then they've rebounded a bit back and forth. So at the end of the day, we've got to be able to navigate through those ups and downs and have a plan. A solid plan eliminates all that fear.
Yeah, 100%. Yeah, volatility is very difficult to on a day-to-day basis to really understand, and that's the whole point, right? If you don't have a plan, you have a plan to fail. So if you're more worried about the return of your money than the return on your money, that volatility can really hit home, right? And when we look at things that are in the market, we're thinking more long-term.
Yes.
So long-term, we know the market's going to be higher in 10 years than it is today. How do I know that, Jordan?
Because every decade we've grown. Even the 2010 barely was up, but every decade the market's higher than it was the previous decade.
Yeah, every 10 years.
Okay.
So when you look at it, in retirement, the issue really becomes when you start taking money out. When you get to the distribution phase. And what is that? That's retirement, guys, right? So accumulation are your working years. Distribution is your retirement years. What accounts are going to take money out? How is it going to be treated? And what happens if the market's down that particular day that we take money out?
Yes.
You know, we look at, we use the word, phrase, reverse dollar cost averaging. I know that sounds very, but if you think dollar cost averaging is where you're putting money in at different prices on the way up, reverse dollar cost averaging is taking money at different prices on the way down.
Ooh.
So easy math, if you had $100,000, let's say, and you lost 30%. Now you only have 70,000, right?
Yes.
And if you earn that same 30% back, are you back to 100?
Yes.
No, you're at 91,000.
Oh.
Now it gets worse if we've taken money out during that downside. So here's the 100,000. We lose 30%. We have 70,000. And let's say we have to take a 4% withdrawal. So we take $4,000 out. Now we're down to 66,000. And we get the same 30%. We're not even back up till 90,000. Meaning 2 or 3 years of that in a row, and your retirement is shot.
Yes.
They used to call it the 4% rule.
Yeah.
Also the modern portfolio theory, the guy, modern portfolio theory.
Yeah,
and he said, just take out 4% of your portfolio and equity and bond mix, you'll never run out of money. Well, the decade of 2000 to 2010 destroyed that. And away we go. Now it's the 2% rule. But talk about sequence of returns risk.
Well, yes,
you could ask me about it.
I would love to. Adam, may I ask you about sequence of return risk, please?
Sure, go ahead. No.
Okay,
All right, so
lasting impact on a retirement plan. Talk about that.
that's okay. That's okay. Yeah. So one of the risks that we've talked about legislative risk in retirement on a different show regarding taxes, right? Because they could raise your taxes. I want to talk a minute about what Jordan actually just was referring to. It's called the sequence of returns risk. And we just want to show you these two random brothers that we've got here. Yeah, those two right there. Those two random brothers, they both have a $500,000 IRAs. They both are taking $30,000 a year out. Will, the guy on the left, retires in 1990, and John, the guy on the right, retires in 2000. Now, let's see what happens. Let's bring up Will first.
Okay.
So you can see here that Will retired in 1990. It was a down year, but the rest of those years, and by the way, that's the S&P 500 right there. The rest of those years were up years. And he's taken his $30,000 out every single year.
Every year.
And he started with $500,000, but look, he's at $1.2 million at the end of 10 years.
And that's after taking out $300,000.
That's after taking out $300,000. He's at 1.2 million.
Wow. Okay.
Now, poor John. Let's see what John. John retired in 2000.
Uh-oh.
You got Y2K, 9/11. You had the housing
recession.
crash. You've had everything in that decade.
Yes.
So you've had all of these bad things, and poor John still taking $30,000 out a year. At the end of those 10 years, he's at $156,000.
Oh my gosh.
So that is called a sequence of returns. It's the sequence of when you take the returns out or take your money out. And that's why we're going to get into this in the next segment, but that's why there is a solution for this. So don't worry if you're sitting at home going, oh no, that's what I'm doing. We've got a solution.
I can't wait to hear it.
I can't wait to hear it. But Jordan, first of all, give the audience the opportunity to get ripped. And what does that mean?
Yeah, RIPT is what we call our personal and customized financial plan. So for everyone that calls in or clicks the QR code, we're going to do a customized financial plan for you. 2 meetings out of your life. Come on into one of our 5 offices around Metro Detroit, and we'll give you a RIPT report. The R stands for risk. How fast or slow are you driving your portfolio? That's what we're talking about in segment today. Of you have to take on risk to get growth, right?
Yep.
How much are you taking on that makes you comfortable? The I is the income plan. Do you have an income plan or an income guess? The P is the portfolio health. Is your portfolio healthy? And lastly, the T is taxation. Let's get Uncle Sam out of there. We'll also give you a copy of our new book as well as your free personal financial plan.
Perfect. Thank you, Jordan. Thank you, Adam. To our viewers at home, it's time for you to get ripped. That number is 888-462-7839, or we've made it even simpler. Just grab your smartphone, click on the QR code at the bottom corner of your screen. That's going to be the fast track to get on the schedule of Main Financial Group. We're talking all about market volatility, as you know, in today's show. But when we come back, let's talk about how you can protect your income no matter what the market does. How can you have peace of mind? Stay tuned. We'll be right back momentarily. Don't go anywhere.
I started out actually going to college and I was going to be a music teacher. I realized very early on, like at the end of my first semester, that it just was not for me. Fast forward many years later, my parents are educators. My dad quit being a teacher and became a real estate and commercial real estate. And after I graduated college, I decided I would go and work for him. And what I really liked was helping people make money. And I realized that that was more my calling than actually selling real estate. So I ended up getting into the financial advising world. It was a big jump, but it was the fact that I was going to be helping people rather than selling people. And that makes a huge difference in my mind. I have enjoyed it tremendously. When you can tell a client, hey, guess what? You can retire. It's one of the best days of my life right there. It's not about my goals. It's not about my office's goals. It's about their goals. It's their money. We need to educate them in order for them to continue to live in a manner of which they become accustomed. Selling is terrible. Educating, getting people to understand why we need to do it this way and consult with them, that's the way to do it.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group. And we're talking about something that we all experience, market volatility. Well, how can you have peace of mind no matter what the markets may do and may bring your way? That's what this next segment is all about. And gentlemen, I know creating peace of mind for people in the viewing audience, for your clients when they come in, market volatility can be scary. So how do you help someone protect their income when the markets are so unpredictable? What are some things that can be utilized?
We always use the saying of ROI takes on a different meaning in retirement, right? Before you retire, ROI is what, Adam?
Return on investment.
That's trying to grow it, right? But in retirement, ROI now is reliability of income.
Oh, I love
so
that.
So what are different guaranteed income sources you can create, right?
Okay.
Because income is the outcome in retirement. So we spend a lot of time designing buckets of money that only produce income so that people can get, when the market's down 10 or 20%, it doesn't impact their lifestyle.
No. Okay, excellent. So I have to ask you a question. The concept, viewers at home, and I know you've heard this term before, paychecks and playchecks. How does that fit into someone's overall retirement strategy?
Right.
Adam, playchecks and paychecks.
Well, again, I think we've got a graphic for everybody at home to see it. Okay, so we have these, we call them buckets at our office. We have a yellow bucket, a green bucket, and a blue bucket. The yellow bucket is market growth. And if you notice, there's a line there that says risk, right?
Yes.
So we know that we've just got done talking about sequence of returns risk. We know that things that are in the market can go up and down. Overall, we know for a long period of time that bucket's going to grow. We below that bucket, that line that says protected, we have safe growth and fixed money. So fixed money is where we put your paychecks in. Think of your paychecks as Social Security, pensions, fixed indexed annuities with an income rider on it. Okay. Those all sit down there.
Anything that gives you a paycheck without whatever goes on in the market, right? Guaranteed sources of income.
Okay.
And then the playcheck goes in between both market growth and safe growth. Well, what is safe growth? Again, protected product can't go down in the market due to market losses, but can participate in market upturns. You can do that with a covered put, or you can do that with an insurance product, right?
Correct, yeah.
But those are where we can pull money out for playchecks. Everything that you have in your portfolio that is meant to build a paycheck, that is meant to cover your expenses, your sleeping at night money, so that you know where your bill is coming from.
I think it's all about being efficient.
Yes.
Every bucket of money, in my opinion, should have one mission or one goal, right?
Yes.
If this bucket of money's mission is to provide income, it shouldn't have to provide you growth or tax diversification. It should be the best at income. And this bucket over here that's to provide you growth shouldn't have to provide you income, should just grow, right? Divided together, kind of like on a football field, when they snap the ball, everyone runs every different way, right? The blocking guys go here, the receivers go all over, and it looks like it's chaos, but it's actually organized and orchestrated together, 100%. Coordinated towards the same goal. And that's the same way. I put an entire chapter in our book about this called income allocation, allocating dollars to buckets that only provide income. That way your market money can go up and down. You don't have to take it out. And it allows people, as you said, to sleep at night.
To sleep at night. Now look, I am telling you, if you're at home listening to this and you're thinking to yourself, wait a minute, my advisor has never talked about this, or my advisor says, don't worry about this. You need a second opinion. And I know that we continue to put our phone number down there, and we continue to put the RIP report down there.
Yes.
But this is exactly why we want to meet with you.
Yes.
Yeah, well, the biggest fear of retirees is screwing up and living too long.
Yes, running out of
outliving
money.
your money, right?
Yes.
We have a lot of clients that retire down to Florida or what we call snowbirds.
Yes.
And they one of our clients says that he thanked us because he always wins money on the golf course. And I said, well, his name is Todd. And I said, Todd, what do you mean you always win money? He says, because I have a guaranteed income plan. It doesn't matter what the market goes up or down for him for those buckets of money.
Yep.
He plays golf, and they play in the morning, all these retirees, and by the back 9, the stock market is open. 9:30, the market's open, right?
Yep.
And he says all these guys are on their phones worrying about their brokerage accounts. And when the market's down, they can't concentrate on golf. And he says, I'd clean them all up in the clean the house in the backyard. So it tells me that Todd's friends down there don't have a guaranteed income plan. They have an income guess. And there's a huge difference there.
There is a huge difference. That is brilliant. But also I want to ask you, there's something I want to talk about, the tools like diversified portfolios and annuity accounts. What roles do those play, if you will, in creating stability for the viewers at home? How does that create stability?
Yeah, well, I think we just kind of alluded to that with the separating the paychecks and the paychecks, right?
Yeah.
So if you have a paycheck that comes in and just like you said, not worried about it, it gives us the ability and you the permission to do things that maybe are a little bit more aggressive on the growth side that will maybe show its fruitfulness later down the line.
Yeah, and a guaranteed income plan opens the doors to all kinds of other things. And to live the life that you want to do in retirement, you don't have to worry about, okay, the market's down. You know, like you said, the annuity programs are great. Those will pay you for the rest of your life. There are several different types of annuities, so you have to make sure you're in the right one. There's some good ones and bad ones, just like buying an automobile.
Absolutely.
And we've talked about those in other shows as well. But the relief of stress that a guaranteed income plan does opens the doors to so many different things.
Right. And I know people out there in the audience hear annuities and immediately they, I don't want to hear about annuities.
Hey, guess what? Social Security is an annuity.
A
And
pension.
Essentially, a pension in one way is a version of annuity.
Yeah.
Pooled risk that they're paying lifetime payments with.
Yeah.
So there are a lot of different tools out there. As Adam always says, you don't just build a house with a hammer and nails. You look at use all the tools
that are available. Yep.
Everything has its job when it comes to building a financial plan. Well, Jordan, this is the perfect opportunity for you to talk about getting ripped. How does someone get ripped today?
Yeah, we're excited about being able to offer this, Cynthia, right? To do a financial plan, a personal customized financial plan for everyone that calls in. Not every advisor group has the ability to do that, right? So 2 meetings out of your life, come to one of our offices around Metro Detroit, and you get your own personal RIP report, which is customized risk analysis. How fast or slow are you driving your portfolio? You have to take on risk to get growth, but are you taking on too much that would make you uncomfortable? The I is what we're talking about now. Do you really have an income plan that can deflect a lot of these eroding factors? Or is it more of an income guess? The P is the portfolio health. What are you paying in fees? How have your returns been? Are you in high-cost mutual funds or nice low-cost ETFs? The T is a really important taxation. Is Uncle Sam still part of your retirement? Most of the time he is. We have ideas on how to get him out. We'll also give you a copy of our new book that came out at the end of 2025. All you have to do is call the number, click the QR code, and come see us.
I love that. It's a great book, Jordan. Thank you so much for always offering that. It's wonderful. To the viewers at home, the number to call is indeed on your screen. That number is 888-462-7839, 888-462-7839. You're being invited into the office so you can get ripped. Make sure that you have a retirement plan that's going to benefit you and to suit anything that comes your way. Once again, we've made it even simpler. You can just grab your smartphone and click on the QR code at the bottom corner of your screen. That is the fast track to get on the schedule of Main Financial Group. We're going to take a very short commercial break. Don't go anywhere. When we come back, we're going to talk a little bit about long-term planning. Think about that for a little bit. How can you have peace of mind long-term, no matter what the markets may or may not do? You're not going to want to miss this segment. Stay tuned. We'll be right back momentarily.
A recent Transamerica survey found that 37% of workers have tapped into their retirement savings early, and nearly 40% have reduced contributions. While these headlines often focus on those struggling to save, they also serve as a reminder to high earners. Don't let short-term pressure disrupt long-term goals. Even with strong assets, a reactive decision now can cost more later. The key is having a plan that adapts with the times so your retirement stays on track.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group. We're talking all about market volatility and how can you find peace of mind and stay calm even when the market is stormy. And that's what today's show is all about, especially this segment. And so when you think about it, gentlemen, obviously planning long-term and really staying on track despite market volatility, so many people have the tendency of reacting emotionally when something happens with the market. how can that derail someone's overall retirement plan? Adam, reacting emotionally, we're all guilty of that. And I know with investment, it's fear and greed are the two main things that drive people.
That's right. It's a fear of missing out. And it's the fear, FOMO, fear of missing out on the upside. Oh my gosh, the market's up right now. I got to get in. I got to get in. And the fear of losing, fear of missing out and taking their money out at the right time on the downside.
We call it panic selling.
Panic selling. So you've got the Oracle of Omaha, Mr. Buffett says when others get greedy, he flees, and when others flee, he gets greedy. What does that mean? You buy low, you sell high.
Yep.
Well, I can't do that, Adam. I need that money for my income. I need that money for my retirement. Well, that's exactly what we're talking about today. You don't. If we can separate that money, and if you're talking to somebody or being with a group that doesn't follow that, they're more in accumulation phase still, you've got to reset your mind to make sure that we're separating everything.
Right, and you have to stick to an investment discipline.
Okay.
Right? And there are different disciplines. So we've talked about the emotional buying and selling is a discipline.
Yep.
Sure.
Day trading is a discipline.
Yep.
Buy and hope is a discipline, right? So we've got to look at it and say a good portfolio is built to take up and down markets into play.
Yes.
And you have to account for there are going to be down times. I mean, look at the silver last year. In 2025, silver was through the roof, the highest commodity. It was under 200%, but it was in the high 100%, huge rate of return.
Yes.
We had a prospect come in and said, and it was January of 26.
Yeah.
You remember this?
Yeah.
At the very beginning, he says, well, I want you to be my advisors, but I want you to put everything in silver.
And we
I
said,
said, well,
no.
Hey, we don't do that. Just put everything in one, and you just go to E-Trade and do it on your own. What happened in January in silver? Silver lost about a third of its value in 1 month.
Right.
So this guy had FOMO, right?
Yeah.
He didn't have any fundamentals or principles that he was investing in.
No.
And, like Warren Buffett said, never buy a stock that you wouldn't keep forever, that you believe in the company. There are a lot of, when you have a plan that you can rely on, that's a good solid plan, it's got guaranteed income, it's got growth components, even got some tax diversification components. Some safety. All those things together, the turning on CNBC and seeing these headlines, it really doesn't impact you. At the end of the day, we've seen clients that come in and they've got guaranteed income plans that fit their lifestyle. I've seen a husband and wife live out their dreams on $80,000 a year of guaranteed income, and they do everything they've ever dreamed.
Aww.
We also have clients that bring in retirement $300,000 of income, and they're always broke.
Always.
Because they didn't design a plan that fit what they really wanted to do. So I think what's really important about this whole show is starting with the end in mind. What is our lifestyle? What do I want it to look like in retirement?
Yeah.
And then build a plan that matches and meets those requirements.
And folks, a statement is not a plan.
Right.
Let me repeat that. A statement is not a plan. Every time you see your statement, you're like, okay, yeah, I'm fine. No. That's not a plan. That's not what we're talking about here.
Yeah, it's the junk drawer. I don't know if you have one of those at home, Cynthia. Right? Like we see a lot of people that come in and they've got an old 401k from another provider, their current 401k. They've got some E-Trade accounts, maybe some CDs at a bank. They have a financial junk drawer that is not coordinated together towards any end goal. And we're losing efficiency when we do that. So we can come in and see us, so we can definitely show you how to do that.
Yeah, my junk drawer has Pez dispensers in it.
Ooh, does it really?
Yeah, it really
does. That is so cute. Okay, I'm not surprised at all, by the way.
Of course not.
So let's talk a little bit about having a clear strategy, how it provides consistency and confidence for retirees and their beneficiaries if you're planning to leave money behind.
Oh, that is such a important thing. So one of the things that we talk about in terms of this RIP report, it's a written plan. It's a beginning.
Right.
Right? But you can even get even more involved in this, and we can really get down from a 30,000-foot view down to the ground level. But more importantly is it's not just what is going to take you through retirement, but how do you want that to look like afterwards? And the 2 days that we love, probably, I shouldn't say love, but are the most emotional for us is when we can tell somebody that they can retire, probably earlier than they ever thought.
Love that.
Right.
And 2 is when they pass away. And we're the first call that they make that the family makes,
Yes.
we want to know, they know where to go.
Yes.
And that makes it so important.
Well,
for them.
your money speaks about you when you're gone.
Yeah.
What do you want? What
Yes.
story do you want your money to tell when it goes to your beneficiaries?
Yes.
Is it to your children? Is it to the church? Is it to
Yes.
universities? We don't want to just waste dollars to Mr. Uncle Sam, right?
Right.
We
Your
want to make sure
legacy.
that it is doing exactly what you want. So, without having a plan, and don't feel bad if you're out there and you don't have a financial plan. A lot of people don't. And if you
Right.
do, it doesn't hurt to get a second opinion. We're willing to do a complete financial plan for you. We want to treat you like our clients for 2 meetings out of your life and show you what we can do. But a good strategy eliminates all these fears and things that we've been talking about
But
today.
Jordan, my advisor, my current advisor, said he would give me a second opinion.
You can't get a second opinion from the person that gave you a first opinion.
I wish I've heard that before.
That's brilliant.
I think
isn't
I
it?
might have said that around the office. Well, there's all these other ones. A goal without a plan is just a wish.
It's just a wish.
A plan without a planning to what? Without
to
a plan is a
plan.
plan to fail.
Yes.
Something like that. A fish
Never
with two
gets it right.
heads,
He
I
never
don't
gets
know.
it right.
A duck
I
with a
love
hat
it.
equals I have no idea.
Now we're talking about ducks.
I love it. Well, again, we should talk about giving the audience at home the opportunity to really get ripped. Jordan, what does that mean before we close?
Yep. We want everyone listening or watching right now to call in or click the QR button and come in and get your own personal financial plan. The RIP report, RIPT. It's a risk assessment to make sure you're taking on the right amount of risk or more or less than you want. We'll get you matched up. The I is an income plan. Make sure you have a plan, not a guess. If you screw up and live too long, make sure you can't outlive your money. We'll show you how to do it. Your portfolio, make sure it's healthy. If you're paying too much in fees, we can show you how to cut those fees. If you're in mutual funds, we can show you great ETFs, stock portfolios, all of that. The T is taxation. Let's get Uncle Sam out of that portfolio. We'll also give you a copy of our book from the end of 2025, Main Street Millionaire, How Real People Build Real Wealth and Keep It. It's a 300-page great financial planning guide.
Jordan, thank you so much. Adam, thank you so much. To our viewers at home, the number to call, it's your opportunity to get ripped. That number is 888-462-7839, or we welcome you to grab your smartphone, click on the camera app right there, the QR code. It takes you right to the screen where you need to be. Be safe, be happy, and be blessed. We'll see you back 1 week from today on The Main Money Show, where Wall Street meets Main Street. Take care.